Welcome to my channel. I'm going to show you step by step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I'm doing this with you throughout the entire video, so it's like we're doing it together. I answer every comment, so please leave a comment if you have any questions. The company we're going to look at is CyrusOne. This is a REIT that invests in data centers. Let's get started with the model. This company has a market cap of $9.6 billion. So that's the value of the company according to the stock market. They're trading at 82.02, so that's one share of stock. And the way you value a company or an asset is you estimate the future free cash flows, then you discount that back to today's value. And that's exactly what we're doing in this video. And now I'm pulling the actual free cash flows. Free cash flow is cash flow from operations minus capital expenditures. And we also need the net income for the model. The net income is the profit and loss on the income statement. And last, we're going to pull the revenue, which are the sales for each year. That's also on the income statement. And the revenue really increases a lot. It goes from 530 million to 980 million. That's a pretty big jump. So even though they had negative free cash flow for 2 years, they seem to have turned it around in 2018 and 2019. Let's look at the capital structure. We need the interest rate they pay on their debt. That's $82 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. And no current debt. Long-term debt of $3 billion. That's debt due after 12 months. They pay 2.8% interest on their debt. So that's the cost of debt. We usually discount the interest rate by the effective tax rate. But a lot of REITs don't pay taxes because they distribute at least 90% of their profits out as dividends. Next, we need to figure out the cost of equity. So we need the beta to get that. And that's how volatile the stock is relative to the market. And they have a beta of 0.47, so it's not volatile at all. It moves about half the market. So it's a pretty safe stock. We need to calculate the current ratio later. So we need the current assets to do that. And that's on the balance sheet. And that's $392 million. And let's see what that's made up of. 76 million cash, 291 million of receivables. We also need their current liabilities. That's 357 million. 122 million of payables. They don't list all the detail out in Yahoo Finance. Let's get the stockholders' equity. It's 2.4 billion. That's the value of the company according to the balance sheet. That's 1.1 million of common stock. Negative 767 million of retained earnings. Since REITs pay so much out in dividends, they tend to have negative retained earnings. And negative 1.2 million of accumulated other comprehensive income. Let's go back to the income statement and get their operating income. That's 76 million. And let's look at the capital structure. 54% debt. Cost of debt is 2.8%. 46% equity. Cost of equity is 5.9%. The WACC is 4.25%. That's a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. That's here in blue. We also estimated a terminal value, which is all cash flows past year for. That's 11 billion. We discounted those numbers back to today's dollar amounts, and we get a value of the company of $10.6 billion. We divide that by 117 million shares. We get an intrinsic stock price of $90. It's trading at $82, so it's trading at a 9% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They're even higher. They're at 124. So Simply Wall Street takes the average of other analyst estimates. Let's see where the stock has been trading the past few years. So it looks like it's almost at its all-time high. It looks like coronavirus hasn't affected the stock too much. Let's look at the financial ratios. They have a really bad PE, a bad price to sales, and not such a great price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 232. So investors are paying $232 for $1 of earnings. They need to bring the net income up. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue or shares outstanding. I like to see below 2.5. They're at 10. So investors are paying $10 for $1 revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 4, which isn't too bad. So investors are paying $4 for $1 book value. They have a good current ratio, a bad interest coverage ratio, and a bad ROE. Current ratio is current assets over current liabilities, so they can cover their current liabilities. ROE is net income over equity, so they don't provide much value to the equity holders, only 2%. Interest coverage ratio is EBIT, $77 million over interest expense, so they can't even cover their interest expense once, and they still have to pay dividends out, so that means they have to take on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos of American Tower, Crown Castle, Hannon Armstrong, Iron Mountain, Power REIT, and SBA, and all in the same industry as CyrusOne. And when you look at REITs, you should look at funds from operations per share. And this is the price of stock over funds from operations per share ratio. And the lower the better. Iron Mountain is doing the best in this category. Cyrus is at 23, which is lower than the average of 33. PE, they're much higher than the average at 231. They are lower than the average in price sales and price to book. They're worse than the average in current ratio and ROE. They have the lowest amount of debt of all the companies in their industry, so that's a good sign. They are much smaller than the average. The average is 33 billion market cap. They're at 9.6 billion. So let me know what you think. I always reply to comments if you have any questions. It could be on any topic. Thanks for watching.